Hi there, I'm Ryan and this is my colleague Chris. We're here today to talk to you about our latest edition of the Dual Index Superstar Plan. So Chris, can you give us a brief overview of the terms, please?
Yeah, of course I can, Ryan. So our Dual Index Superstar Plan is a 6-year term linked to two indices, which is the FTSE 100 and the Euro Stoxx 50. It offers growth of 14% in year one and 10% thereafter. That's based on the criteria of the markets being at or above their initial level at the annual observation kick-out date. Counterparty for this product is Credit Suisse and has a 60% European capital protection barrier.
Okay, so that capital protection barrier is a European, so that means that the worst performing of the two indices can fall by up to 40% at maturity, and you still receive your initial capital back in full.
Yeah, that's exactly right. The good thing about this structured product is, as you've just said there, it's got a 60% European barrier. Now, a European barrier, as opposed to an American barrier, is only measured at maturity. So, as you've quite rightly pointed out there, you've got one point in time, which is at the end of the product, that if the markets have not fallen by more than 40%, you get your capital back, and obviously if the market's at initial level, you receive the full growth as well.
Okay, brilliant.
Yeah.
Okay, so this starts from a minimum investment size from £5,000 as open to directs, ISAs, SIPs. So there's a lot of options for how you want to invest and different sizes, obviously. But how do you feel the markets are going to perform over the next year, 2 years, or maybe even 6 years?
Yeah, I think it's important to realise it. This particular product is designed for a market that's actually remaining quite flat. So if your view is that the market's going to be trading roughly where we are now, so 6,900 roughly, or have a steady increase, this is a perfect product for you because it will mature at one of those points in time. I think on average these typical, these kind of products mature at the end of year 2, going on back testing that we've used in the past. So what's important to realise is you don't actually need the markets to generate a vast positive return in order to generate a good return for yourself. So, if the market strikes at 6.9 today and in a year's time we're still at 6,900, then you get a 14% return. There's not many products out there or equities where you can do that with a flat market.
Okay, so a brilliant way of yielding positive returns even in a flat market or mildly increasing market.
Correct, that's entirely correct, Ryan.
Okay, well, thanks for running through that with us today. Come back for more product videos.